I've seen more companies fail because of shitty investors than shitty entrepreneurs. Unicorns doesn't exist, maybe you don't know. And with Venturerock, we now have a portfolio of 15 companies. We built per vertical a maximum of 3 companies a year.
So actually, it seems like a venture studio, right?
You look like an Excel sheet, Max. An accelerator only helps you in the first phase. An open end means I don't know how much I'm going to raise because we built companies from scratch.
10 years. 10 years.
In return, they get an 8% equity share in every company. IRR was around 40, 46, 48%. The founders really need to be in love of the problem.
Hello, my name is Max, I'm an entrepreneur, and 1 year ago I started to learn everything about venture studios, startup studios and venture builders. I've done my 7 months research on the topic, which went viral on LinkedIn, and recently we held a venture studio online conference with more than 500 people present on the same Zoom conference. Now I'm happy to share that I recorded a podcast episode with Marc Wesselink, a founder of Startupbootcamp and the founder of Venturerock. So, a Startupbootcamp is an accelerator which worked with more than 1,000 startups, and Venturerock is a venture studio started 5 years ago in 2018, and they created about 15 companies. What's interesting about this episode that Marc has both experience in the accelerator model and the venture studio model, and we discussed many details and many differences. So I hope that this would be very interesting with a lot of numbers. Please like and go to the Venture Studio family P2P community. You can find the link under the video. Hi Marc, I'm very happy to be here with you on the Venture Studio podcast, and we'll talk today about Venturerock studio. Please, can you tell your story, like how it started, why you have chosen this model?
Okay, hi Max, thanks for having me. A little bit about my history, because then you also know my future. So I'm a 12-time founder, failed 4 times, sold 3 companies. 1 got IPO'd, stock exchange, but also had, unfortunately, 2 bankruptcies during the 2008 crisis. So I have a few things under my belt. Since 2008, I'm some sort of intrigued by the process of building companies. I personally always prefer to call it a car wash for companies. Idea comes in, company comes out. Since 2008, I'm building a process of testing and iterating based, of course, on my experience, but also a lot of research being done on that point that led me to become a co-founder of Startupbootcamp in 2012, which became one of the top 5 global accelerator programs worldwide. But then I saw that still a high percentage of companies fail due to top 5 reasons why companies fail. And I thought 3 months is too short. So we need something that takes 3 years. So in 2018, I've launched a car wash for companies of 3 years, where we invest at idea stage, and we release money in 72 small steps, and a total amount of 2.2 million from pre-seed to Series A.
Is it a part of Venturerock, or it is another company?
No, Venturerock has built what we call a Venturerock operating system that consists of 3 layers. The bottom layer is a tokenized entity where we can issue but also retract shares towards founders. The second layer is what we call the slicing pie, built also based on the slicing pie model of Mike Moyer. Slicing pie, it means that every person who adds value to the company also gets a piece of the pie. And on top, we have a third layer That's 4 phases of investments, which is being deployed based on 72 small steps, which we are measure in almost real time.
Can we call Venturerock as a venture studio?
According to the industry, a studio is some sort of a company that does a lot of iteration and builds MVP within the company itself, and then based on a product market fit finds a CEO or a team. We start already with the CEO from idea stage. Our step 0 is a founder problem fit, where we first define the problem, but then also find a founder who is also in love of the problem together with us. And then together with him or her, we start building and iterating the company.
Mm-hmm. So actually, it seems like a venture studio, right?
Yeah. So according to the industry, we are a venture builder studio because in some cases, we also invest in later stage companies if it's a fit to a profile. It's sort of a fit to our portfolio. We have several builder studios currently in different industry. One is active in Los Angeles within the sports tech industry, one in Amsterdam in fintech, one in Singapore in AI, and one in Dubai within urban innovators. And the people involved are coming from that industry, have a background in the industry, have also operated in the industry, invested and entrepreneured in the industry, failed in the industry. So there's a lot of knowledge within.
Can you tell about Startupbootcamp, like how these two organizations work simultaneously? What are the differences? Like maybe you can share the number of startups which participated in Startup Bootcamp and the number of companies co-created with entrepreneurs in Venturerock.
So Startup Bootcamp has now, I think, 1,100 companies accelerated in almost every continent on the planet, also in different verticals. But it's a 3-month accelerator program where in the start it was on-premise, but now it's more online, where a cohort of 10 companies with a specific focus are being led by a team of professionals through a 3-month online guidance program, where they come from validating till fundraising, and then in return they get an 8% equity share in every company. They invest a small chunk of cash and a lot of services in every company, and in return they get 8% of the cash. So it's a portfolio of a large portfolio of many companies. Mm-hmm. But unfortunately, after the 3 months program, there is not a lot of interaction anymore, and I've sort of seen also too many companies fail because of too much money, wrong investors, wrong hires, CEO, and also the founders were not fit for the phases that the companies were in. So there were a lot of still issues along the way. So that led me to be more actively involved for not 3 months, 3 years. So that's Venturerock. And with Venturerock, we now have a portfolio of 15 companies in different stages. We built per vertical a maximum of 3 companies a year. In fintech in Amsterdam, we've now built a portfolio of 12 companies. In sports tech, we now more or less to 3 companies. And AI in Singapore is just starting.
When you started Startup Bootcamp, what was the year?
It was already, I started an accelerator program in 2009, and it was very small. And then I lost a few years of my focus. And then I wanted to start an accelerator program again. But then I got in touch with one of the founders of a program in Amsterdam. And I sort of draw down my a 3-year process of building a company. We mapped it a little bit for 3 months, and then we said, like, let's join forces because, it's better to, if you want to go fast, go alone. If you want to go further, go together. So I joined after they done their first program in 2012. So since June 2012, I was involved. I think from June 2012 till October 2018, we ran about 32 programs in Amsterdam, and worldwide around 70 programs.
Mm-hmm, mm-hmm.
So 10 companies per program.
How is it structured? So, for example, in venture studios, there is some capital in the holding company, and there are some funds. So mature studios, they raise the funds which invest in companies they create. But in the accelerator model, how does it work? So it's also like several funds you raised.
The accelerator program is done SPV wise. So we created an SPV, and then we gathered a bunch of informal investors, sometimes corporate investors. The company ran a program for 3 years and holds 30 companies in portfolio. And then we went and we started an SPV for every vertical. And our own studios are built in an evergreen structure. I don't believe in closed-end structure, but it's built in an evergreen fund structure, managed by a studio entity, a management company or a studio entity. Depends on what you call it. And of course, in the studio, we have a lot of people supporting the ventures, but in the ventures themselves, the founders plus subject matter experts are active in the startup themselves.
If like for every 30 companies, it means that about 37 SPVs you created for this 1,100.
You're fast. You look like an Excel sheet, Max. So I think they are now around 30, 35, 36. I don't have the latest update, but.
The biggest experience or difference between an accelerator and a venture studio, and you have this both experiences with both models from you as a founder and you as investor in those models. So what is the difference, and how can you describe for what types of founders it's better to start an accelerator, and for what types of founders it's better to start a venture studio? All the differences you see between those two models. Of course, there is 3 months in accelerator and 3 years in the venture studio, but more differences.
So I think for a venture studio, we are looking more for experienced founders. They know how hard it is to start a business, and they need all the help they can get. I think one of the best comparison was made by one of our investors in the sports tech. He's a famous soccer player from the Netherlands, and he said, "You're like AC Milan," because AC Milan took care of everything, and so I could only focus on soccer. An accelerator program, you need to do everything, but also a very learningful experience. So for first-time founders, I think an accelerator program is a very good tool to learn, but also build a network of people that can help you starting your business. But an accelerator program, and also the companies in accelerator program, they do everything in-house. They build their own teams. And with the venture studio, we do much more shared service. Finance, legal, tax, admin, the whole shebang is being arranged by our venture studios, or in our case, a sort of shared knowledge center. And an accelerator program is everything doing it yourself. Last but not least, an accelerator only helps you in the first phase and gives you a little bit of money. Sometimes you get like a follow-on round, like Techstars or YC. They're not YC. YC is only one go, but there are different accelerator models that also deliver follow-on funding. In our studio model, we keep on funding it for the entire pre-seed to Series A round. We invest a total of 2.2 million in every company, as long as they make progress. If they don't make progress, we stop.
Maybe it's not enough years for Venturerock. studio to say like what is the performance in comparison with an accelerator, but if you can share like how many startups are successful from this 1100. Did you invest only your money, or you attracted also a lot of investors to invest in those companies? So how this works? And
So
what is the IRR, if you can share?
yeah, the IRR a little bit different. The IRR of a venture builder is way of venture studio venture builder is way higher because of the fact that they are more in control. But then the amount of companies that you can build is of course way lower. The accelerator model is more spray and pray. And on average, I think the IRR was around 40, 46, 48%. So that's not bad.
It is for the venture studio.
No, for the accelerator program, but the venture studio is twice as high. It's way higher.
Wow, super.
Because we also believe in the fact that the founders are also replaceable. I've seen within Startup Bootcamp that many companies fail because many founders think that they need to put it through the end. But I've seen and I've also learned that people in different phases is much needed. The people in the start are often not the right people to scale, and vice versa. And secondly, it's building a company is one of the hardest thing to do. And I always compare it. It's not a sprint. It's a relay marathon. So you also need to implement in the company a relay a marathon way of working. Yeah, and therefore we can also push the company to a much higher pace because now of the relay, some people are really good in the first 2 years, and then they move maybe to another, or move away and start something else, or start working at an incubator or the corporate accelerator program. Very hard in both ways.
What is usually the amount of capital in each SPV, and how is it distributed? Or maybe, I don't know, there are some administrative costs also for this program.
It depends on where SPV was based, but on average between 2 and 3 million per SPV, and the SPV was paying for operating and investment in. So, and often they get 15, 20K per company. I think in Africa we did around 20K, and no, the other way around. I'm not. Sometimes it's 15 and sometimes it was 20K, and then the rest, I think around 30 to 40K services. So office, events, network, software, those things.
Mm-hmm. But you say that it is for 3. The program is for 3 months, but SPV is for 3 years. So what happened next in 3 years?
So after the program, they some sort of entered what we called an alumni program. But the truth is that a lot of startups are fast-moving objects, and they are really hard to communicate with because I'm busy, running. And therefore, I saw also a lot of companies fail because of that, right? Mm-hmm. And that's why I believe in the more 3 years hands-on, or so not hands-on, but more, and also not hand-holding, but together building the company instead of only 3 months. And most of the companies, they went on fundraising, and then the shit show started in many cases because they got too much money or got the wrong investors. I've seen more companies fail because of shitty investors than shitty entrepreneurs.
Let me just understand. So there is intensive 3 months program in the accelerator, and then after you have some help and services also for these companies, right? For 3 years, you said.
So they have some sort of knowledge base, access to a knowledge base, and of course access also to the team, but they need to reach out themselves. But the fact was that many were too busy to reach out. So there's not really a strong weekly or monthly connection between the accelerator program and the teams, unfortunately. Mm-hmm. And of course, in the studio, it's a totally different ballgame because we are really 3 years involved heavily.
how you were able to manage this accelerator? Like you created like
You can't.
35. Yeah. So what
Yeah.
is your team or structure, and how you attract investments into each of these SPVs?
Of course, it was one of the hardest thing to do to attract early stage companies, early stage funding for early stage companies. So I don't have to bother on that part. But I think in many cases there was a group of informal investors that was also linked to the specific industry, and and also 3 or 4 corporate investors slash sponsors. We had also banks stepping in, insurance companies stepping in, and they didn't invest but sponsored. And that was, of course, better for us because we didn't lose equity. It was better to have sponsors than investors. In all cases, yeah, the 3 months program was the asset, and then of course then the little bit of the guidance and the network was after. But yeah, in many cases, companies went down under. In of course the months after the accelerator programs, but fortunately also many made it really pulled it through to the end and made a fantastic exit. So it's more a spray and pray model.
I understand that the accelerator, these SPVs, they take 8%. Out of this, I don't know, money collected from investors in these SPVs, what is the remuneration? So is it something like 220 in the funds, or a different approach, commissions or remuneration for the team of
No.
the accelerator?
So we as a team were also a shareholder of the SPV. In some cases, we had 20, 30, and even 50% of the SPV.
And so for investors, like what is your charging for investors? I just want to understand. Like
a program. So we invested 15,000 euros in the startup. Back in the days, it was bigger program, was way more costly. And I think around 85K of services. And services means program, events, the whole bank team, etc., etc. So that means 30 times 100K was 3 million. But most of the time, the 3 million was invested by external investors and or sponsors. And in return, we also have a percentage of the company. So we, on average, I think we hold between 30 or 40% of the SPV. And there was always a lick pref. So when there was an exit and a distribution, all the investors that put money in, they got their money back first. And then it was distributed by pro rata shareholders. And in our case, I think in Africa, we have 50% of the entity.
So this doesn't mean that you invested your own money in these SPVs, but you hold.
Yeah, a lot of no. We did in the first 4 or 5, but then other people stepped in.
About the team, I'm interested in how you were able to manage this across different continents.
Yeah. It was more. So sorry, I forgot to mention that. But it was more an event team, more a senior program director, which is often an entrepreneur or a subject matter experts. It was more around events, organizing events and workshops. And in the studio is more about working together on your company. And with an accelerator program, it was more some sort of a weekly with your team, or with my team, but also with the startups team. But I did not help them to build a front end, or I did not help them to build a back end. That's something they need to do themselves. But of course, in the studio, that's your added value. You literally help building the company from the ground up.
How Startup Bootcamp is going now? Like, what is the current stage?
Startup Bootcamp now launched also larger SPVs, so you can now invest in 300 companies at once. So it holds 10 SPVs in 10 different verticals. So as an informal investor, suddenly you have a spread of 300 companies. And that's, of course, really attractive from a spread perspective. And that's now what their future is, building mostly online programs. And sometimes they have one or two moments that they come back to the office. And from an investor perspective, you invest in a huge spread of early stage companies without having the daily job of guiding those companies.
We are moving to the venture studios, but I want to understand during those 3 years and 80K of support, what was included and how is it different from the venture builder or venture studio?
Now, an accelerator program is much more geared towards network, getting first customers in. We organized events where we invited 30 or 40 corporates slash mid-sized companies that were looking for innovation in their field. And we hoped that there was some sort of a connection between the startups and the corporates that we invited. Second, we organized multiple events to invite investors to see how they are progressing throughout the accelerator program. And of course, it always ended with a demo day where we hired 400 or 500 people event with sort of pre-selected investors. And based on the pitch on demo day, they attract the right investors, or even better, an investor that is also our customer.
So you share something like 40% plus, 50% or 45% of IRR. Can you tell it, like, I don't know, how many companies became unicorns? Or just huge companies, how many of them
I think the unicorn bullshit, unicorns doesn't exist. Maybe you don't know, and so does Santa Claus. It doesn't exist either. It's either a successful company or a mid-sized company. Yeah, you have small, medium, and large companies. And to me, I've always said you're creating a bigger impact if you create 100 companies of 40 million. Than one company of 40 billion.
Because usually when there is a big valuation, this means that a company just got a lot of money at a huge valuation, but it doesn't matter that like they're doing the same impact, right? Or what is the idea?
Imagine if you have 100 companies worth 40 million, and those 100 companies, they have 2 or 3 founders and 4 or 5 employees, which all are part of the 40 million. That's a huge impact. Right, and then you have 3 or 4 people that, and maybe the first 5 employees that are part of a 40 billion company, and of course, lazy financial people that became investors. They have a huge chunk of their profit. And so I rather build 100 companies of 40 million than one company of 40 billion.
Of course, you have an accelerator. Right, great. But why you created Venturerock, and it is a venture studio with not so many companies, 3 a year. What have you seen 5 years ago that you decided to do it?
I saw more companies fail because of obvious reasons. And I thought, like, I'm not going to waste energy on companies that are some sort of making the same mistakes every time over again, even after multiple warnings from me or my team. I rather want to focus on a few companies and doing it really in a proper way than spread my time and efforts amongst many companies without having a proper influence of the outcome. That's the first reason. The second reason is that I really believe that we can create what we call a venture development program where a lot of founders can benefit from if they follow the right process. And to prove, I've now built a few companies that went through those processes. We're not there yet, but we're getting there, and show that if they follow certain process, that their chances are really, really, really increasing. And one of the most important parts of it is, of course, the start. As you also know, that the biggest reason why companies fail is that there's no market need of a product that they build. Almost the half of failed companies fail because of the fact that there is no market need. And it's very simple. It happens after you have an idea, and then you start looking for money. The first investor says, "Okay, you show me something," and then he or she start building something. And then when you build something, you start showing, and then you don't have the right feedback loop with a potential customer, because then you get more focused on the product, but you need to focus on the problem. How big is the problem, and how much money is it worth for your first customer to solve that problem for him or her? And that phase is, of course, the customer discovery phase of Steve Blank, is the most effed up phase of a lot of startups. Mm-hmm. And with a studio, you can create time and also focus on not fighting or getting money in, but more really understand the problem. Mm-hmm. And I think that's unique on a studio model, if it's done in a proper way.
Can you tell a bit more about the Evergreen model in the studio?
So an Evergreen, so there are two structures for a fund. It's a closed end and an open end. A closed end means I raise 10 million. I need to raise it within 1 year, and I need to deploy it in 5 years. I need to manage it for 5 years, and after 10 years, it needs to be dissolved. An open end means I don't know how much I'm going to raise. You can continuously fundraise from people, but people are stepping in based on a certain valuation. Yeah, if you have one company, it's a different valuation than if you have 2 companies and 3 companies. And the reason why many people dislike Evergreen is, of course, the valuation of a company. That's always debatable. So we said, okay, let's square that thing out. Every valuation of every company in the first 5 years is bullshit in the first 3 years. So let's use data and use that data points to create some sort of a valuation, a NAV, net asset value of a company. Based on that NAV, that's where we all agree upon. And sometimes NAV is too high, sometimes too low. It doesn't matter. It's on average. Yeah? Every investor steps in at a certain time based on a quarterly calculated NAV. And of course, hopefully the NAV will go up. Yeah. But the beauty is that they can also sell it after 3 years. Because an open end is also possible that you can sell it. Closed end you can't sell. Mm-hmm. Open end you can.
Mm-hmm. But they sell inside to other investors, right?
To other investors. So we have now, I think, 60 investors in our Evergreen structure in the Netherlands.
60?
60. And we want to scale it to around 200 in the next year to come. So then you have some sort of a base of people that can step in or step out or acquire.
I heard the problem with holding company model, or I don't know, maybe you have SPV for this. The problem is that it's very difficult to calculate this NAV when you have many companies. Do you think it is a problem, or you can just calculate for each company and every investor believes that it is a fair calculation?
No, that's the beauty of a studio. So every single company that we build is working on the same platform, same admin, same KPI, finance KPI, compliance KPIs, product KPIs. Mm-hmm. So we have a full transparency from top to bottom. So on a daily basis, I can now open the screen and I see every company, what they do, how much cash they burn, how much cash they earn, etc., etc., etc. I can also see their performance KPIs and the compliance KPIs because we built companies from scratch. Mm-hmm. If you do it a later stage, and you said you acquire or you invest in a company, and you say you need to work on my platform, they say bye bye. I'm not going to publish my data with you. But in our case, not a problem. So we can see in real time the progress of every company. Hence, measure the based on data points evaluation. It's a different ballgame.
And it is one SPV in Amsterdam, or
the Evergreen is not an SPV. The Evergreen is a fund structure, but it's an open-end fund structure. So it's not an SPV because it's managed by the studio entity. Yeah, and you have LPs and GPs, but the GP is a studio. We now have one in the Netherlands. It's based on a cooperative. So a cooperative legal framework in the Netherlands, a variable capital company in Singapore, a Delaware registered investment club in the US.
Registered investment club, is it also like a fund or what?
Yeah, it's also an open-end structure in Delaware. Yeah.
What is the equity split between a studio, fund, and entrepreneurs in your startups?
That depends how much money they need, how much money they spend, how fast they go. If they have early revenue, they earn much more equity. But if they have late revenue, they lose much equity. But in all cases, it needs to be a fair distribution of value for all parties involved, right? And sometimes we can also do a combination of equity and debt to make sure that the founders doesn't have 1.1% of the entity and we keep on 99%, because then you also have an unfundable company. But it's a little balance between us and the founders. But on average, we target a little bit the same rates as other studios. But mind you, we invest till Series A. So in most studios invest 100K or 150K, but we invest 2.2 million from pre-seed to Series A.
Studio takes about 20% maybe. Fund takes about up to 30 probably, or maybe even more, something like this.
Yeah.
And founders, you say that they are more experienced entrepreneurs than those who go to accelerators.
Yeah.
What are your criteria for the founders? How do you look for them?
We start with the problem, and build a venture on top of it. So for us, it's really important a founder problem fit. The founders really, really need to be in love of the problem. And that's also something they need to prove. So that's really important. 2, they need to have complementary soft skills and hard skills. Yeah. And 3, they need to have full-time availability and also certain domain expertise in the team. Not both, but there needs to be some. If you go build a fintech company and you don't know anything about the financial industry, difficult.
Did these entrepreneurs have previous entrepreneurial experience?
Yeah, in our case, one of my goals was also validating my assumption of attracting experience in entrepreneurs or not. We tried to convince 4 first-time founders to also start working with us, but they didn't accept our terms. Almost all our founders have previous startup experience because they know how incredible hard it is to build a company while fundraising at the same time. Because 99% of the founders don't like fundraising. It's one of the most gruesome jobs to be done in a startup.
Jobs to be done of a venture studio. We are investing. You don't need to fundraise, at least during the first stages of a company. Please tell about your steps. So you said that there are many steps. Like, what are, I know the book, there is a discipline entrepreneurship book with 24 steps.
Yes.
But you did how many?
We have divided the 4 steps of Steve Blank, 4 steps to epiphany, into 72 small steps. So first phase is customer discovery. It's 0 to 19. The second phase is customer validation. It's 20 to 25. The third phase is customer growth. It's 26 to 48. And then the fourth phase is, of course, company scale. And that's step 49 to 72. The fun part is phase A and B for us are one-to-one disciplined entrepreneurship. I love Bill Ole. I love the simplicity of his steps. And especially the first 19 steps is all about listening and discovering about the problem and not building. And the step 20 to 25 is all about lean startup, so build, measure, learn, but not in the first phase. First phase is purely based on understanding the problem, understanding the stakeholders, understanding the problem we're solving, but also the quantifiable value proposition. How much is it worth? And based on how much is it worth, is it also a market size interesting enough to focus? And if not, you need to go back.
How much time does one step take? Or maybe this 4 big stages, like how much time?
On average, 3 months, 6 months, 9 months, and 18 months. So in 3 years, so 3 plus 6 plus 9 plus 18.
So like every next step is more time needed.
Yeah.
But do you stop pursuing some ideas when you understand that, okay, there is no demand? And how often does it happen?
So that's the beauty of start with the problem first. The problem is always existing, but is the team savvy enough to build a solution for it? And find the first paying customer that gives you feedback to build a solution that fits and also is valuable to them, so they want to pay. And that's one of the hardest things to do, right? In some cases, the team stops, but the problem still exists. So and so the company, because we are also in control of the start of the company, and we now also have the team stopped because they were not able to build the right solution, and now we got a new team of 2, and within 2 months they did more than the other team did in 8 months.
Am I right that the entrepreneur joins after your team insight validated a problem and you?
Yeah. So in some cases, if you know the market and if you know the industry, it's already easy to define a list of problems in that industry. But the most important part is a founder problem fit, that you find a founder that's also fit to the problem and that has the stamina and the resilience to go building a solution for it, but also the ability to listen. Not people are able to listen.
Usually there is a dilemma I see many studios have, and the question is like, do I have to start with entrepreneurs from scratch on the idea generation phase or problem finding phase, or you have to join, you have to look for an entrepreneur later? And usually like there are pros and cons. So I see that if an entrepreneur is starting with the venture studio from scratch, so they can be like a bit in love with this idea or problem. So like maybe less risks that an entrepreneur will then give up if something happens, because like he or she is from scratch here. But if you already validated an idea and you are attracting entrepreneurs, I think that you are able to attract a bit better entrepreneurs because they already go, and someone already pays, your customers already may pay for your future product or not.
So for me, one key item is always founder problem fit. The founder needs to be in love with the problem, because otherwise you get a CEO and you pay a CEO to get a job done. And if there's some sort of a headwind or some things go wrong, they're off to another job. No, a founder is all about resilience.
How do you understand that there is a founder problem fit?
That's done by a very thorough interview, including have a drink with them and have dinner with them, of validating the fact that he or she is a problem owner. Now, I sometimes compare it with if they feel the stone of the problem in their shoe on a daily basis. If they are having nightmares about, so there are a few ways to get that to get that across. But that's for me the number one.
Can you give just maybe one or two examples of your companies in Venturerock that like you understood that we are doing this product and a founder has this problem?
So one of the companies that we've built is called WeVestor. And WeVestor is a full transparency platform between the founders and the stakeholders, which we also using to monitor our companies. But it's also being used by many founders to update their stakeholders in real time. It was based on a problem statement that I've created after my years at Startupbootcamp, because it was a nightmare to manage a portfolio of 700 companies. We did not know anything about where the companies were, what they were doing. Asking them updates was also a nightmare. And I interviewed a few people, and I got across a person who has built a company, but had also crowdfunded the company via two crowdfund platforms. And it was almost his daily task to manage 272 crowd investors. And also having them updated on a regular basis. So he felt the problem on a daily basis, and he really wanted to solve this for his fellow entrepreneurs.
Then you mentioned that a venture studio has double IRR that of an accelerator. You measure it also by this NAV.
Yeah.
But did your companies get external investments from other I don't know, VCs?
Yeah. So at a certain stage, especially in the last stage, we are always connecting to strategic investors. So not dumb money, but strategic investors from customer distribution or a potential exit point of view. And we already want to involve them as early as possible and let them also invest in the last stage that we invest as well.
Maybe you want to share something, or we didn't take some important topic that you think you have a unique experience as so I completely understand that you have a unique experience having experience with both models, accelerators and venture studios, but maybe there is something else, and you think that it will be important to share with all founders of venture studios and with those who are considering either venture studios or accelerators.
It's sort of course, there are a lot of discussions about the dual entity model and or single entity or holding model.
Yeah.
I believe we need to start embracing open-end, aka evergreen structures.
Evergreen
I believe Evergreen is the best solution for this. It's still a dual entity, but of course the fund entity is a evergreen structure. And I know that a lot of investors are pushing against it, but I really believe that this is the best structure for studios. And the more we embrace that model, the higher the chance of convincing LPs to start investing in it as well. Because we are involved from day one, so we can really have real-time metrics on how the company is doing. And the beauty of Evergreen is, of course, that people can step in and step out at any time. And if you do it in the right way, you have built a perpetuum mobile, because it's a pump, boom, boom, boom. If you exit, you can redistribute it in a new company. You don't have to go through the cumbersome process of setting up a second fund, third fund, fourth fund, or sixth fund. Number two, there's also a lot of thinking around, do we need to have a studio team that's doing all the work and have only one CEO doing the startup work, versus all the people in a team and only some sort of a Darth Vader in the studio. I think it's a combination of both. You need to split it in half. Finance, legal, tax, admin, marketing, presentations, the whole shebang can be easily done by a central team. But specific knowledge about the user interface, et cetera, it needs to be in the startup team, because it's very specific. You can't handle 5 user interfaces at the same time. Then you get like a cookie factory. So I think the best model is to have the specific subject matter expertise, of course, in the startup teams, but the generic DevOps, you can do it from your studio team. Architecture, you can do it from your studio team. We've made many mistakes on that part. We had in different startups, we had DevOps. So what the fuck are you doing? You're hiring a DevOps, which is not so. That's something we've learned as well.
But developers are in the startups.
Yeah, but not the full Monty. So we set up the platform on AWS or Google or whatsoever. We do DevOps. We also help them with the architecture, etc., etc. The user interface is, of course, much more important to do that in a team. But marketing team, communication, we can help with from the studio team. So that's 2. 3, and that's something that we are also currently working on. We need to combine forces. We are in an incumbent asset class, and I really believe that we need to combine forces with a fund of studios. So currently we have set up a fund of studios in Abu Dhabi. It's one of the most transparent and international financial structures, and we are aiming for 250 million fund of studios, where we, not our own studios, but also can fund other studios, because this is an asset class which is much more interesting than venture capital. Venture capital is gone. Spray and pray and wait till something blooms. It's not of this time anymore. So I really believe in joining forces. And I hope this podcast can also help you and me in joining forces. So if there's a studio who likes our approach and want to join our fund of studio, please ping me on LinkedIn, because I really believe that venture studios are kicking ass towards venture capital, and venture capital will become non-existing in the next 10 years.
Wow. Wow. Super. 10 years. What will be in 10 years?
I see your eyes like, ooh, let's try. But yeah, there are. So I've been a part of investment committees of many VCs, and they don't know fuck all what they do. 9 out of 10 don't know anything about what they invest in. 9 out of 10 VCs don't want to lead; they only want to follow. 9 out of 10 VCs are not entrepreneurial. They're led by bankers and wankers. 9 out of 10 VCs, they don't have any entrepreneurial experience. 9 out of 10 VCs stops after setting up the first fund. 9 out of 10 VCs underperform. They're not being outperformed by any index in Europe. It's totally ridiculous asset class.
Let me know what do you mean by when you say that you're creating a fund to invest in studios. So do you plan to invest in, I don't know, the holding companies or in evergreen funds of other studios if they decide to do it? Both.
Yeah, both. So I believe that the evergreen structure needs to also put some money into the studio to get the first ball rolling. We have created some sort of a money flow system for that. Yeah, because it's all about mechanics.
what are usually fees in this evergreen structure in comparison
So
with?
as low as possible, because we say cost is 1%, carry is 30%. So it's a performance-based fee instead of a cost-based fee. But mind you, the startups are delivering services, the studio is delivering services to the startup portfolio companies, and they need to be paid at cost, of course, not 200 euros an hour. But that's how the flow works.
Is it your case that you have a venture fund, Evergreen Venture Fund, which is like 1% every year plus 30% carry, but probably it's like waterfall, like every deal for every deal.
Yeah. So it's always with an evergreen, you have a high watermark structure, and of course it means that there's a lickpref, so everybody always gets their money back. But then the upside is being distributed 70%, 30% to the studio, and 70% to the investors.
From each deal, right?
Yeah.
But like when an investor invests, they get actually shares like in all companies. If one company,
mind you, we're working with the NAV, so there's we have a price per. In our case, we have tokenized our evergreen structure, so that means somebody is holding a unit, and a unit represents a certain value. And but he or she also paid a certain value for the unit. And so, for instance, I think 2 weeks ago, somebody stepped in our evergreen structure at a price of 12.32 euros per unit. And if somebody is buying it for 20, then profit is split between us and the investor. That's how it works.
And out of this evergreen structure, some money are paid to studio to cover its costs for the team. What is the size of team?
I think 6-7 people per max.
7 people for
DevOps, architect, marketing, Marcom, Scrum Master, financial, legal, and chief to keep. Entrepreneur who's helping pushing it to the next level. Biz dev. Yep.
Is it easier to attract investors into evergreen structure, do you think?
No, most certainly not. Because it's one of the hardest thing to do, but the more we use evergreen is by far the best structure. Because of 3 simple reasons. It's a machine. So you don't have to end it. 2, closed end is always 5 + 5, so maximum 10 years. Well, you can't exit a company in 10 years. Many companies, it takes longer time to exit. And I've seen too many companies almost fail because they're pushed out by a VC fund. So it's total nonsense. And thirdly, you can also do a buy and hold, right? Because at the end, if it's a company is growing, you don't have to sell it. It can also grow and maybe even create dividends from which you can even buy or start new companies from. So it's a much more flexible structure. And it's not being used for classical VCs because they can't push transparency towards their portfolio companies. But we can, as a studio, we can.
And am I right that for each region, like you said, Singapore, the Netherlands, and the US, so there are 3 teams of studios, or this 7 people?
Yes and no, because we have a central legal team, and we also have a central marketing team that helps both studios. But we also have local teams that are really topic specific. So in the US, there are also people involved that knows a lot about the sports industry. But architects, DevOps. That doesn't matter. DevOps in sport, in esports or fintech or AI, it's all the same.
Uh-huh, uh-huh. Yeah, thank you. Thank you very much, Mark. This was very interesting to know about the differences between an accelerator and a venture studio. A lot of numbers we are here. 15 companies, around 15 companies in the venture studio. 1,100 went through the accelerator. Yeah, and double IRR. This is all venture studios they want to hear this and then show to the investors and say, look.
Yeah, but mind you, it's a hard job. We made also our mistakes.
Well, yeah, maybe you can cover some of your main mistakes in the venture studio.
Yeah, not checking the founder problem fit.
Ah.
There were people that some sort of faked being in love with the problem. That's number one by far. Two, fundraising. I underestimated fundraising. Last year was, of course, a nightmare to fundraise. We also had a few investors stepping out at the last moment. We had a big ticket investor from a large logistical party in Europe. But they sort of canceled their investment last year, thanks to Mr. Putin. But also a guy signed an investment agreement, did one capital call, but the second declined because he lost a lot of money on the stock exchange. It's quite a nightmare. But then again, if it was easy, everybody was doing it.
Mm-hmm, mm-hmm. Probably in the evergreen model, and in your business for the last 14 years, probably your main job is fundraising, right?
No, no. So no. So with the SPVs, we had some sort of a network of, but in the last 3 years, it almost looks like my life is all about fundraising. And that's why I also believe in combining forces in a fund of studios, because there are a lot of big LPs that want to invest in studios, but they can't because of the small ticket size. Yeah, we literally are in contact with a few parties which have a minimum ticket size of 50 million, but they can't be part of a structure more than 20%. So that means that you have a 250 million fund. Yeah. No studio has 250 million. So how to deploy 250 million in startups? So you need to combine forces.
Atomic raised 320 million this year.
Who? Atomic. Yeah, but Atomic is a different ballgame. Atomic is of course also VC. And partly builder. Of course, there are different numbers, but they also are not truly a venture studio or venture builder. They do combine also a lot of stuff, right? And it's also partly based on follow-on funding for the first batch. So it's also a little bit marketing. We raised 220, but can you imagine that you need to deploy 250 million in a studio of startups in one studio for 5 years in the first 5 years?
Waste of money.
It will be a waste of money. It will more be like boom, 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 and some sort of throw spaghetti at the ceiling and see what sticks. That's not my. I really want to build companies that are solving problems that are worth solving, and not pumping more shit shows like Bird, Lime, Gorillas, or Get Here on the planet.
Super, Mark.
Let's start focusing on real problems that are really changing the planet, guys. Because
super. Thank you very much for this interview. A lot of numbers. It's very interesting.
I hope all the numbers will be some sort of. Probably you put an AI to work and some sort of analyze our conversation. I'm very curious on how many numbers are being messed up.
Yeah.